here today. I do have a bit of a better pleasure of being here today as opposed to a year ago. I won't say I can tell you exactly what's going to happen, but we have less uncertainty over not knowing what's going to happen. Which is to say we still don't know, but I'll pretend like I do. The story is a bit better though, so that's sort of the silver lining here. Normally the economists will get up and depress you. Our job is kind of to be the opposite of what everyone expects. So during the recession, we tell you, things are bad, but they could be worse. And then when times get good, we tell you they're good, but they could be worse. So right now we're in that sweet spot. I'll tell you things are getting better. So we'll sort of move through that. What we've experienced was something that the world really hasn't seen since the 1930s. The other fortunate thing of speaking now as opposed to a year ago, I'll have a lot less references to the Great Depression, so that should hopefully leave a little less indigestion in your stomachs at this point. But really what we saw the global economy as a whole contract on over the course of 2009 for the first time since the Great Depression. We haven't seen such a coordinated event around the world. The shock that we saw in terms of this banking sector mistake in the US really rippled through into the global economy extremely quickly. No one was able to escape the fact of what was going on, whether it came through their financial sector, whether it came through the collapse in the manufacturing side and the exports and the trade around the world. This really spread around the world extremely quickly. And that really made for a very scary time at the end of last year. We were seeing this coordinated event spread into areas that it really shouldn't have. In terms of areas where the banking sectors were perfectly sound, where they had plenty of capital, where domestically there was lots of room for these countries to be growing. No one was able to escape this. And so that left us a bit concerned, and it left governments a bit concerned. So what we saw was an unprecedented attempt by central banks and by governments around the world to try and put enough stimulus into the economy so that we wouldn't make the same mistakes that they made in the 1930s. And what we're seeing is it seems to have worked rather well in terms of what we're getting right now. We saw interest rates across the 10 largest advanced countries around the world get to practically zero. Every central bank went down to this point, whether they're at 1% or less right now. They all got down to try and get enough monetary stimulus into their economies. They all started spending massively, as we've sort of read in the papers day after day about all the little issues that have come here and there. But we saw a massive amount of government spending to try and fill the gap from the fact that businesses weren't investing and consumers weren't spending. They wanted to fill that gap and try and get the economy moving forward. That really did start to send a positive impulse through the markets. The first thing that we saw was that it started to relieve the stress we were seeing in the financial sector. We saw the spreads on corporate bonds get to levels again that we haven't seen since the Great Depression. I think that's the last time I have to say that. The spreads on here were really making it prohibitive for businesses to be investing. And so we saw this collapse in business investment at the end of this year. Businesses were worried that the consumers weren't going to be there, or that the consumers weren't there already, but on top of that, even if they wanted to invest, it became extremely difficult, especially if you were in the United States, especially if you were in Europe, where the banking sector problems were really localized. You simply couldn't get funding. That was the big difference between Canada and a number of the other advanced economies during this. In Canada, you still could get funding. It was just at a bit more of an expensive premium. Whereas in the US, there was lots of talk back and forth over the last year that lots of times interest rates were higher in Canada than they were in the US or that they were in the UK. The difference was those Canadian rates were higher than the posted rates in the US and the UK. The difference was that if you were in Canada, you could at least get a loan at that rate. If you were in the US or if you were in the UK, you couldn't actually get a loan regardless of what the interest rate was set at. We've seen this financial stress really start to ease since March and April. What the governments were doing, what the central banks were doing, finally started to filter through, in addition to the fact that simply a number of the large investment banks just had to take their licks. And so a lot of that write-down had already come by that point. So we started to see the financial markets ease. After those credit markets started to ease, then you started to see the relief come into the stock markets. After that sort of collapse that we had with Lehman and Bear Stearns and the string of bad events last year, we've seen about a 40 to 60% up in terms of stock markets across the world again. Right? We've seen this sustained rally, just as sustained as it was, sort of horribly synchronized as it was on the way down. Now we're seeing a wonderfully synchronized move back up. Whether you're looking at stock markets, you're even starting to see housing markets turn back up. That was sort of the epicenter of the problem. And the issue was that in the United States, as long as housing continued to contract, as long as those home prices kept falling, all of those crazy financial products that had been based on the US homes were going to continue to lose their value, and all of those big investment banks that were invested in them and holding them would continue to see those write-downs. So you needed to see that chain broken. We're actually starting, we're getting some of the leading indicators, we're getting some of the construction figures out of the US. It looks like you're starting to get a rebound in the US housing market. A lot of that is just a function of how little construction is going on right now. You're down to about 500,000 homes in the US, which is about a quarter of where it was at the peak before we even got into this. And it's less than a half of what would be considered average for the US. So part of this rebound is just the fact that someone somewhere wanted to buy a house, and just by one person buying it, you've now doubled the growth rate of the housing market in the US. But growth is growth. So when you're looking at GDP, you're getting that growth going in. You're getting the economy moving again. And it doesn't help, it doesn't hurt that you've got the government putting in $8,000 for any new home buyer in the US to get in there and try and get some new demand coming in. So you're actually starting to see signs that even home prices are starting to bottom in the US. So you're getting that positiveness moving around. All of these positive impulses are now working through the global economy. And what you're seeing is whoever did the worst in terms of their contractions coming into this, and we can see Japan in this point, their industrial production contracting by about 25% at its worst point during this, now starting to shoot back up. So part of this is this natural rebound you tend to get at the end of the recession. The concern was that financial markets were in such bad shape that you weren't going to get this rebound simply because businesses weren't going to be able to get out there and get the credit because the banking sector was that impaired. We're seeing that because things have improved so rapidly, you're getting that credit out and you're getting a rebound. It's not as strong as it should be given how bad the downturn was around the world, but you are getting a rebound, you are getting growth. Now it's just sort of a question of how long will it take us to get back there, but we do seem to be on a path towards some sort of growth again. So we'll start with the US. Most bad news stories obviously start with the US. So we'll start there. We'll move ourselves into Canada at the end of that. What we saw, 4 to 6% contractions in GDP in the US for some time. It looks like in the third quarter they've now turned. You're going to get an initial rebound. A lot of that is going to be the auto sector. We're still kind of looking at the numbers, but given some of the cash for clunkers that went in there, given some of just the natural growth effects, again, similar to the housing market where there was nothing going on and now you have some construction, so you're seeing growth. In the auto sector, you had so many plants shut down at the end of last year. Now that they've just simply turned back on and started producing some cars, you're getting growth in the auto sector. And it actually looks like, even though autos only make up about 2 to 3% of the US economy, they're probably going to add about 1.5 to 2 percentage points to GDP in the third quarter. So you are getting some sort of growth in there, and we'll come back to that once we get to Canada, because that's where you're starting to see some of that impulse now moving into the Canadian economy. But it looks like we're going to see this rebound at least through the end of this year, maybe into about the first quarter of next year. Then we do think you're going to start to see a bit of a slowdown, not getting back to contraction, but there are still some long-run issues to deal with. We're not out of the woods in terms of, we never ever have to think about anything that happened over the last year again, unfortunately. But I think you'll see a bit of that rebalancing, a bit of the fact that all that fiscal spending basically took growth from the future to spend during the recession. That give back is going to come back in about the middle of next year. That monetary stimulus, cutting interest rates to zero, that probably starts to dissipate by the time you get there. And the economy really has to run on its own 2 legs. Right now, we're running on government stimulus. When we start running on our own 2 legs, we're going to see a bit of a slower growth, and we'll slowly start to move out there. But that line, 2%, that's what we think average US growth is going to be for some time right now. You can compare that to the 3% growth rate that was average for the US before we got into this recession. So there are some issues when you're talking about the fiscal stimulus that we'll come to. But I mentioned that sort of turning point in housing. One of the big issues, in terms of turning the housing market around was just the fact that you had this massive inventory of homes just sitting there unsold. And you really couldn't sell the homes fast enough to keep up with the fact that you kept having new delinquencies, new foreclosures, adding to this glut. At the end of the day, just like the sort of purple polka dot sweater that sits on the shelf at the store and no one wants to buy until they cut the price low enough, you had to wait for home prices to keep getting cut, and eventually someone wanted to buy it. So we're now starting to see people move into the housing market. You've seen some counties in California where prices have fallen 50 to 60% over the last year. That was enough to start to bring people back into the housing market.